Hey everyone, let's talk about something really important for 2025, your financial safety net. Today, we're going to dive deep into how to build a truly smarter emergency fund. We're moving past the old, outdated advice to create a system that actually grows with you in today's economy.
But first, I want you to think about this for a second. Your savings account, it feels safe, right? It's predictable. But what if I told you that by just sitting there, your hard-earned money is probably losing its power, its value, every single day? It's a bit of a shocker, I know, but it's the reality we have to face.
And that's exactly why we need to kick things off by rethinking savings altogether. For years, the go-to advice was just to park your emergency cash in a savings account and call it a day. But these days, the hidden risks of that approach are just, well, they're too big to ignore. And this right here really lays it all out. Look on the left. Traditional savings get you, 3 to 4% returns? That often doesn't even keep up with inflation, meaning your money is literally buying you less over time. Now, look to the right. A SIP-based fund isn't just about getting better returns. It's about turning passive, lazy saving into a disciplined, super effective strategy. It's the difference between treading water and actually moving forward. So if the old way is broken, what's the fix? Well, that brings us right to the SIP advantage. A systematic investment plan, or SIP, is an amazing tool that is a complete game changer for how you build your financial safety net. Just look at this chart. It says it all. Your typical savings account might get you about 3.5%, but a conservative SIP in a debt fund could potentially double that, hitting around 7%. Now, that might not sound like a lottery win, but over a few years, that difference starts to compound, and your emergency fund actually grows faster, not slower. And it's not just about the returns. SIPs build discipline because the investment is automated every month. You get those better returns that beat inflation. And here's the crucial part. You still have high liquidity. You can get your cash in just 1 to 3 days if an emergency pops up. Plus, and I love this, you can start with as little as 500 rupees. This is a strategy for everyone. Okay, so we've covered the why. Let's get down to business and figure out the how much. This next part is all about calculating your personal target. There's no one-size-fits-all answer here. It's about finding the number that lets you sleep soundly at night. This table is a fantastic place to start. If you've got a steady salary job, you're going to want to aim for about 6 to 8 months of your essential expenses. But if your income's a bit more up and down, if you're a freelancer or run your own business, you'll want a bigger cushion. So think more like 9 to 12 months. Just take a look and see which category feels like you. And the math behind it? It's wonderfully simple. Just add up all your essential monthly costs. We're talking rent, groceries, EMIs, utilities, everything you absolutely have to pay for, and multiply it by the number of months you just picked. That number you get? That's it. That's your target. It's your peace of mind put into a number. So you have your target. The next huge question is, where exactly do we put this money? That brings us to choosing the right funds. And let me be perfectly clear here. For an emergency fund, our number one priority is safety and getting our money out fast. We are not looking for risky, high-growth investments here. We're going to be focusing only on what are called low-risk funds. Think of these as investments that are designed first and foremost to protect your money and make sure you can get it quickly when you need it. They're low risk because they invest in really safe things, like government securities. This is not the part of your financial plan for taking big swings at the bat. The two best choices are right here: liquid funds and ultra-short duration funds. As you can see, liquid funds are incredibly low risk, and you can get your money out the very next business day. That's what T+1 means. Ultra-short duration funds give you slightly better returns for just a tiny bit more risk, and it might take a day or two to get your cash. And see that exit load? That's just a tiny fee if you pull out your money too soon, but it goes away after just a week or a few months, which makes them perfect for this. All right, this is it. This is where we put all the pieces together. We've talked about the why, the how much, and the where. So now, here is your step-by-step plan to make it happen. Let's build this thing starting right now. Here's the game plan. Step 1, you've already done. You know your target number. Step 2, pick a timeline that feels right. 18 to 24 months is a fantastic goal for most people. Step 3, based on what we just talked about, pick 1 or 2 of those low-risk funds. And finally, step 4 is just some easy math. Divide your target amount by your timeline. Boom, that's how much you invest each month. And now for the final, most important steps. Step 5 is the magic key: automate it. Set up an automatic transfer from your bank so you don't even have to think about it. For step 6, just peek at your progress once a quarter to stay motivated and make sure you're on track. And step 7, the one that makes all the difference, stay disciplined. Consistency is absolutely everything here.
And this quote just says it all, doesn't it? Using a SIP to build your emergency fund isn't some complicated financial trick. It's genuinely one of the smartest things you can do for your family's future. It perfectly blends the discipline we all need with the safety and quick access that an emergency demands.
So there you have it, the why, the how much, the where, and the step-by-step plan. You literally have all the tools you need. Financial security isn't some far-off dream. It's a real, concrete goal you can start chipping away at today. So the only question left is the one on your screen. What's your first step going to be?